Welcome back to Investing Talk Podcast.
Today we're looking at Snowflake.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. When we look at Snowflake right now, what we're really seeing is this crucial balancing act.
A balancing act. How so?
Well, you have a market leader that's trying to juggle massive scale, real profitability, and at the same time, these hyper-growth expectations from the market.
And they're doing all that while staring down a huge competitor.
An incredibly aggressive private competitor, Databricks.
And that contrast, the public profitable giant versus the private super fast challenger, that's really the whole story here, isn't it?
It absolutely is.
So let's start there. Can you kind of frame for us where Snowflake stands right now in just pure scale compared to Databricks?
Sure. So if you look at the financials, Snowflake is operating at a larger revenue run rate. They're projected to hit about $3.6 billion.
By the end of this fiscal year.
Exactly, by the end of Q4. So it's a massive business, but its growth rate is, let's say, steady, around 27%.
Okay, steady. And Databricks.
Now look at Databricks. They're smaller, expected to hit about $2.6 billion. But, and this is the key, they're growing at nearly double the speed. We're talking 57%.
Wow. So Snowflake is the established leader with the bigger revenue base, but Databricks is just aggressively gaining ground.
It's the classic tortoise and the hare, but for the cloud data world.
And does that difference in approach show up on the bottom line?
Oh, it defines everything. Snowflake is significantly more profitable. And a lot of that is, the pressure of being a public company. You have to show margins.
Right.
They're profitable on an operating margin basis, sitting about 20 to 25 percentage points ahead of Databricks on that front.
And that focus on profit gives them a respectable Rule of 40 score, right?
It does. They come in at 32%. Which, for a company of that size, is very, very strong.
And for anyone who doesn't know, the Rule of 40 just adds up the growth rate and the profit margin. Over 40% is considered exceptional.
Precisely. And that's where Databricks gets all the market enthusiasm.
Because they hit that magic number.
They hit 41%. So the market is effectively saying, look, Databricks, we don't care that you're losing hundreds of millions of dollars this year.
Your growth is what matters.
Your 57% growth is so compelling, we're willing to forgive the losses. And you really see that belief reflected in the valuations.
You certainly do. I mean, Databricks has been valued at a 30% premium to Snowflake?
A substantial 30% premium on a next 12-month revenue basis. It's 16.2 times for them versus Snowflake's 12.4.
So the market is heavily rewarding that high-octane growth.
That's the whole dynamic. Snowflake is asking investors to value resilience and profit, while Databricks is asking them to value pure, unbridled growth.
Okay, that sets the scene perfectly. So let's pivot now and build the case for Snowflake specifically. I mean, despite that valuation difference, the company's financial resilience it's undeniable.
That resilience is the absolute bedrock of the bull case. They just consistently outperform expectations.
We saw that in the last quarter.
We did. They reported, 35's earnings per share. The estimate was $0.27. So a huge beat.
And revenue was strong too.
Revenue was very strong, came in at $1.14 billion against a consensus of $1.09 billion.
Beats like that show fantastic execution, especially in this kind of macro environment. But what's the one financial metric that really separates Snowflake from the pack?
It's their conviction in free cash flow, FCF. Management has gone on record forecasting a 25% FCF margin for this fiscal year.
25%. I mean, think about that.
In a sector where so many companies are still burning cash, Snowflake is promising a 25% margin. That level of confidence is rare.
And that predictability is just gold for any valuation model. At that margin, we're talking about FCF of over $1.12 billion.
Which is about a 20% jump year over year. You're buying a cash-generating engine.
Yeah, exactly. And that gives them a huge cushion.
A massive one. It lets them fund all their R&D and acquisitions without having to go back to the markets.
Okay, so the cash is there. What about the customers? How do we know they're truly locked in and not just shopping around?
The metrics are screaming it. Their net revenue retention rate is fantastic. It's at 126%.
126%. So just to break that down for you, if a customer spent $100 last year, they're spending $126 this year.
Exactly. Even with no new customers, the company grows. Their existing customers are their fastest growth engine.
And that's driven by their usage-based model, right? More data, more queries.
More spend. It grows naturally. And beyond that, you can look at their remaining performance obligations, or RPO.
So their contracted future revenue.
Right, and that number just surged 33% to $6.9 billion.
$6.9 billion. That's essentially a guarantee of future revenue. It signals really high switching costs.
Precisely. Once you're in that deep, you are structurally locked in.
So, deep customer commitment, immense financial power. But that won't matter if they fall behind on the biggest trend right now.
AI, the AI cloud data market.
Exactly. Snowflake's core is data warehousing, the foundation. How are they making sure they don't lose the AI race?
They're innovating and innovating aggressively to bridge that perceived gap. The focus is on making AI accessible to, well, to everyone.
And they're doing that with these new tools like Snowflake Intelligence and Cortex AI Equal.
Yes, these new agentic AI tools.
Agentic AI. That sounds a little like jargon. What does that actually let a user do?
Think of it like a smart assistant built right into the database. Cortex AI eSchool, for example, lets you use plain English to ask complex data questions.
So you don't need to be a coding expert.
Exactly. The system translates your question into the right code and gets you the answer. It democratizes AI, moving them way beyond just basic analytics into smart AI applications.
That is a game changer if it works as promised. And they've been using acquisitions to push this too, right?
Yes, a very targeted acquisition strategy. They bought Select Star to boost their AI capabilities, and, crucially, they also bought Datometry.
What does Datometry do?
They focus on one of the biggest headaches for big companies, getting off old legacy systems like Oracle.
And their pitch is pretty bold. I think I saw them claiming they can cut migration costs by up to 90%.
That's the claim. And if that's even close to true, it makes the decision to switch to Snowflake a no-brainer for a lot of CFOs.
And the platform itself, being multi-cloud, that has to be a huge strategic moat.
It's critical. It becomes more valuable every day as companies look to optimize costs. Snowflake has about 35% of the market.
And being vendor neutral is key to that.
It is. Customers can use the best tools from AWS or Azure or Google, but keep their data unified in Snowflake. It's the bridge.
So they're the intelligence layer connecting everything.
Exactly. And they're also supporting open formats like Apache Iceberg, which shows they want to play nice in the ecosystem. It helps attract developers.
Okay, that's a remarkably strong bull case. Execution, cash flow, customer lock-in, and a real AI strategy.
It is. But now we have to look at the other side.
The risks, which seem to center on valuation and, well, the sheer cost of building this fast.
The risks are significant. It comes back to that profitability gap we talked about. Despite that strong FCF, the company had a huge GAAP operating loss last year.
How huge are we talking?
$1.46 billion.
A $1.46 billion loss on a GAAP basis. We need to explain what's creating that massive chasm between their non-GAAP profit and that number.
The primary driver, and this is pretty standard for high-growth tech, is stock-based compensation, SBC.
Right. Companies argue it's a non-cash expense, so they exclude it to show a cleaner picture.
But you, as an investor, have to care about it. It might be non-cash, but it's not free. It dilutes existing shareholders.
It's a real cost. And that massive GAAP loss puts a ton of pressure on them. The forward PE is what, over 200?
It's over 200. That's Wall Street betting that they will close that gap. And fast. If growth slows even a little, that valuation premium could just evaporate.
And growth slowing is a real possibility given the competition.
The competitive intensity is extreme. From the top, you have the hyperscalers, Amazon, Microsoft, Google, aggressively bundling their AI offerings.
Why pay for Snowflake if Microsoft is giving you something similar right inside Azure?
That's the threat. And from the other side, you have Databricks, which a lot of developers still see as being better positioned for the really high-end generative AI stuff today.
It's a squeeze.
A total squeeze. They have to execute flawlessly.
Now let's talk about maybe the single biggest red flag in the bear case. And that's what the insiders, the people running the company, are doing with their own stock.
Yeah, this is a major point of tension. In the last 6 months, company insiders have logged 242 separate sales transactions.
And how many purchases?
0.
242 sales.
Yeah.
0 buys. That's an astonishing figure.
It is. Now, a lot of this is probably scheduled selling for compensation, but the sheer volume and the lack of any buying, it suggests insiders think the stock is fully valued right now.
At best. We're talking hundreds of millions of dollars sold by top executives.
The CEO sold over $674 million in shares. The CFO over $82 million. It's a very clear cautionary signal.
But, and this is the ultimate contradiction, that insider selling is happening while huge institutions are piling in.
It is. Institutional conviction is incredibly strong. Norges Bank just bought over 4.2 million shares. Kingstone Capital Partners took a new position worth nearly $3.9 billion.
So the big money outside the company sees a different story.
They're betting the long-term vision, the FCF, and the strategic moat will win out. Overall, institutions own over 65% of the stock.
And what's the consensus from Wall Street analysts?
They remain largely bullish. The consensus price target is floating around $268. They're betting Snowflake can narrow those gap losses while keeping revenue growth above 24%.
So what does this all mean for you, the investor, at the end of the day?
Well, Snowflake is a classic high-risk, high-reward proposition. You have a market leader with undeniable cash flow, but you are absolutely paying a significant premium today for tomorrow's profits.
The key, then, is to watch two things.
Exactly. First, you need to see real, measurable progress on improving those gap operating margins. And second, you have to watch the sustainability of that product revenue growth. Can they keep it above 25% with all this competition?
It's a fascinating battle. The question for you isn't just whether Snowflake can win the AI race, but whether a public company can afford to prioritize growth over profit long enough to actually win it.
That is the tension.
It certainly is a defining case study in the modern cloud era. Make sure you hit the subscribe button to keep up with our analysis of Snowflake and other major players in the tech space.